Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ended 14th of November. So, a lot of things happened this week. Unexpectedly, the government has scored a victory in Bihar. It wasn't expected this kind of a landslide win for the NDA. They have again managed to win the voters. It gives a lot of confidence to the markets actually, with the stability of the government in place, and it spreading to other states also now. So while it was mostly already priced in, but even the best of political experts were not expecting this kind of a outcome or the numbers. And that also extends and brings to the point about investing, where we can make all kinds of projections, and 99% of what we see around us, the noise, is all about predictions and projections, but really nobody can say what is going to happen. So following the trends perhaps is the saner and easier way of dealing with the randomness in the market. The US markets are also a bit in turmoil. The big short guy, Michael Burry, he has he's of course big time short on AI stocks, and he's taken a lot of puts, etc. And now he has taken his positions private, returned public money. That has caused a flutter in the entire global markets, where people are questioning uh, the valuations or the levels at which Mag 7 and some of these AI companies are trading at. I mean, Nvidia is at 5 trillion, which is equivalent, almost equivalent to India's entire market cap. Bitcoin has been selling off this week, from recently at a high, I think 1,25,000. We're now down to 95 or 96,000. So each of these falls in certain asset classes is either going to have a short term negative correlation or negative implication with other asset classes, because if you get hit on one side of your portfolio, you want to protect the other side of the portfolio, not lose more. That is the sort of your first instinct. But then over a period of time, the money that comes out of any asset class goes into another asset class. So in my view, while India is not yet hit, in the short term we may have some repercussions of, if this US thing and the crypto world also sort of starts to decimate. uh, but over a period of time, this money will then flow towards emerging markets. I think that is the, and Indian market is reasonably strong right now, despite whatever tariff business we've had in the last 3 or 4 months. The market has not really buckled under that weight, and the result season has also gone through without any much turbulence. So I think we are set for going higher. It is only a matter of triggers and lack of bad news if we can get that kind of space for some time. Let's see some charts and see where we are this week. From our research desk, we had these fantastic stories to share with you. India and China rising power, how the next global growth story is going to take shape by 2040, how India market has transformed in the last 10 years, understanding the link between money growth and market growth and money supply, the unbelievable rise of Nvidia and what it teaches investors, understanding big stock gains and hidden risks. So these are some of the stories that we shared with you on the newsletter, on the blog, and a lot more on YouTube, long videos and short videos. Disclaimer as always, please read fully, understand it, and only then move forward in this video. And of course, do subscribe to our channel. Let's look at some charts. This is the daily chart of Nifty along with the 20 and 100 DMA overview. You can see Nifty is comfortably above the 20 DMA, very comfortably above 100 DMA. It is very near a stone's throw from an all-time high. So Nifty is very comfortably placed right now. On the weekly chart, you can see it broke out 4 weeks back, went higher, came back, retested this trend line where it broke out, and has gone up again. This is a very, very strong chart actually. So now until we break this low that we created last week, I think we are good for going higher. 1.64% this week. S&P 500, despite the volatility, is still up 0.08% this week. Some of the bigger stocks in the US have taken a dip, whether it is Nvidia, whether it is Palantir, Tesla, many other stocks. But still S&P 500 is maintaining. Gold is up 2% this week. It was much higher during the week, but In the last 2 days, there was some sell off. We are at 12,333 per gram on Indian rupee terms. Dollar index is beginning to wane, minus 0.28% this week, but not really. That trend downwards has not really started, which one is looking for, which is going to help not only the India markets, emerging markets, and precious metals, but all risk on assets. This is the global indices overview in dollar terms. So all markets are presented here in dollar terms. This is a very unique data point that is not available, as far as I know, anywhere on the net. The team works really hard to make sure this data reaches you. So my request again is to please subscribe to the channel if you haven't, and if you like the data. Nifty this week 1.6% up, Nifty 500 1.3% up. The best performer is Brazil at 3% up in dollar terms. Europe is also not too far behind, CAC 40 2.9%. That's France. Euro stocks of 50 also 2.2% up, and you had Canada also move up 1.8. What was down was Russell 2000, which is the larger index, larger cap, the larger base index of US, minus 1.5% there. Australia is down, and Nasdaq also is down. So India has done reasonably well versus others in this week. Over the last 1 month, of course, we are nowhere in the picture, 3% and 2.8 versus 14% of Brazil. Over 3 month period, again, Brazil and Japan have done well. Over 6 month period, almost all markets except India and Germany have done well. And in the last 1 year, surprise, surprise, Germany has done the best. Sorry, Hang Seng has done the best at 36.9, followed by Germany, followed by Brazil, and we are not here. But when we look at 5 year returns, we at this Nifty 500 index of India is the world leader in terms of returns in dollar terms. So India got lumpy returns, and now it is waiting for its time to start again, basically. Hang Seng in the same time period has given nil returns in almost 5 years. In the momentum score picture, you can see Brazil is at the top. Then you have Japan, Hang Seng, Canada, Europe in that order. Nasdaq and Dow Jones, etc., are in the middle part, and Nifty and Russell 2000 and ASX is at the bottom uh, quadrant of this chart. So if you're looking for shorter term or even medium term opportunities, these markets are where the opportunities are right now. In the benchmark indices overview, this week gone by, Nifty has gained 1.6%, mid cap 1.3%, Nifty 500 also the same. Nifty next 50, very surprisingly, has moved only 0.6%, and small caps have virtually not moved at 0.3%. In the sectoral overview, defense stocks have started moving up again, 4.1% move this week. So defense is also moving up, not only on order flow, but also on prospects of more announcements on defense stocks in the budget, which is perhaps less than 1.5 months away, or is it 2.5 months away? I'm sorry, and that kind of buildup can happen. Pharma is up 2.9%, IT stocks up 3.4%, infra up 2.4%. These were the notable gainers on this week. In the sectoral momentum ranking, you can see that defense is at the top. PSU banks also have been on the top, although in the last 1 week they have slipped. PSU bank, a lot of narrative is floating around that some big restructuring can happen within PSU banks, and that too probably will happen at the budget. Capital market stocks have come back with the fantastic IPO listing of Grow, and also the news that the weekly expiries are not going away, and SEBI is looking at other measures to revive that segment. Auto is also doing well at the number 4, and oil and gas stocks at number 5. What is at the bottom is media, FMCGs at the bottom, tourism, central PSCs and PSCs. These have been at the bottom. IT also has been at the bottom, but off late, in the very short term, it is recovering. Pharma is also recovering, and infrastructure is recovering. That is in the trend in the short term. In the weekly advanced decline stats, micro caps have the most declines at 55%, and others have declined. Nifty 50 has the least decline. So my uh, suspicion is that significant FI buying is happening here. Perhaps we'll see at the end what are the FI numbers. But other segments have seen 30 to 40% kind of declines, which is reasonable. I mean, 68%, 78, 68, 62, 53, 45, and 60% advances for different indices. This is reasonably all right. Nifty has the least market cap, the market cap which has the least drop from the top. So 57% of Nifty stocks have dropped less than 10% from 52-week high. So Nifty is maintaining a lot of strength. Just see the next one is at 16%, 15, 11, and 10. So Nifty stocks really have outshone all other segments in a very, very big way. And just the two within 20% itself, almost 70% of stocks get covered. Um, Whereas the broader part of the market, the small caps and micro caps, are mostly 30 to 50% down, and most of them actually are in this segment. So the skew is very much towards Nifty stocks right now, where the least damage is there. Percentage of stocks outperforming benchmarks. So if we look at this last 1 week, Nifty Next 50, while it did not perform much on the index level, but 62% of the stocks within Nifty Next 50 outperformed the Nifty Next 50, and others were very near 40 50%. If we look over 1 year, then Nifty has 53% stocks outperforming the Nifty, which is not such a large number actually, and these numbers are quite abysmal actually. So some concentrated moves are happening. Like 45% of small caps have beaten the small cap index, 55% are still below that. In the strength and weakness within benchmark indices, this indicates how strong and weak each segment is. So brutal strength is where you know uh, price is greater than 25-day moving average, which is greater than 50-day moving average, which is greater than 200-day moving average. So it is like stacked up very nicely as you are going from price towards 200 DMA. So 33% of Nifty stocks are in brutal strength. You want to be in that space actually. Nifty Next 50 also 32%. Mid caps have 28%, and these ones are very, very low actually, 18%, 17%. Brutal weakness is only 6% in Nifty. So 6% on 50 stocks is just three stocks basically. So only three stocks is where you want to avoid Nifty. Whereas this is 20% in Nifty Next 50, and similarly in all other segments. Golden cross, which is a good sign where 50 DMA is greater than 200 DMA. That can be a good sort of a setup to look for trades. Nifty has 78% golden cross, where 78% stocks have 50-day moving average more than 200-day moving average, which is a good setup for bulls. Nifty Next 50 has 70%, and others are also nearly 60%. So golden cross is happening across the board. Death cross is primarily more significant in mid caps, small caps, micro caps, and even CNX 500. You want to avoid stocks which are in death cross. Let's look at some of the stocks. So Power Grid, Trent, and Tech Mahindra are in brutal weakness for Nifty 50. You would want not to be here if you are a trend follower. And within the Nifty Next 50 space, IRFC, VBL, PFC, ABB, Indian Hotels, Shree Cement, REC, Evels, Bajaj, HFL, and Naukri. These are satisfying the conditions of brutal weakness in the Nifty Next 50 space. So ideally, a trend follower will not be there, but those who are looking for bottom picking, perhaps this could be a good list for them as well. Is the trend improving or declining? So if we look at 50 DMA first, so we are at 50%. We've been at 50% since last couple of months, give or take a few percentage here or there. So we're not really improving, but not going down as well. On the 200 DMA also, it's almost like a flat line around 55, 56%. So there's hardly any change on this front also. So the trend really is not strong either way, up or down. Trend check across sectors. PSU banks have 100% stocks in PSU banking list which are above the 50 DMA, which is a very good sign. So PSU banks is where you'll get good setups. Real estate is at 90%, metals, private banks, autos, financial services, and commodities. So these segments are where 50-day moving average has been crossed, and you probably are looking at short-term good setups. In 200 DMA segment, again, metals, private banks, autos, financial services, infra, and commodities have more than one-fourth of their uh, stocks, more than three-fourth of their stocks in above 200 DMA. That also is a great filter for looking at these sectors and finding stocks there. You can see that CNX 500 is at 56%. So metals at 93% is far ahead of the market average actually in terms of percentage of stocks doing well. and some sectors are far behind also. So media is at 20%, it is at 40%, and so on and so forth. Let's look at FI data. So FI data, I was wrong. All 5 days has been selling, um, and this is basically coming after few weeks of no selling, and then mixed, confused signal. And this week has been completely a sell from FIs. DIs have been buying, although the SIP data for the last month has come in lower. So I think the confidence of the domestic buyer at some point will also start to wane when they will find that 1 year has gone by and I'm not getting returns, because new investors mostly do not understand market cycles. Uh, I would say new as well as those who have spent, like, let's say 4 or 5 years, they do not understand the market cycles because market cycles tend to be longer, and the market cycle that we've had since 2020 is a very unnatural, not a normal market cycle, where we had a huge boost in the first 2 3 years and then some flat areas. So uh, people have not really experienced the bear cycles, the normal sort of curve of the market, and hence frustration or disappointment is likely to happen, because when you come into the market and you make money on day one, and you feel like that market is a instrument or a vehicle where you can just come in any time and make money. It doesn't happen like that. When it happens like that, you have been lucky, basically. So plan for 5 7 years kind of a outlook for at least one cycle, so that the idea of 5 7 years is that during that period you will get one really nice bull run. That is the whole idea. It could be 8 years also sometimes, but the idea is that you should be able to live during one bull run and then assess whether coming to the markets was good for you or not. If you come into, let's say, a period of lull which was happening for a year and a half, like last September till now, is no real trend. So we spent 14 15 months with no trend. Somebody came in September, and a lot of people actually came in September of 24, and now they are feeling a bit frustrated that our portfolio is not moving. So this has to be seen in the right framework, that markets are not a short term game. I mean, either you're playing a short term trading strategy, then that is fine. Then you have to evaluate basis that. But if you are playing long term investing game, then you have to give it a full cycle to really evaluate what's happening. A lot of people are talking about now, bank FD returns have been better than market returns. I mean, you can't see it that way. You have to see it over 10 years, 20 years. What has markets done? People have made wealth like nobody's business in the market. So you have to give it time, and you have to be in a vehicle which is self-evolving, self-correcting, so that you don't get stuck anywhere. And normally, when people will start to invest, they think that they can do a lot of good stock picking, but after a bull cycle, when the bear cycle comes, they get stuck with those stocks, and they are not able to sell them or change them. That is where having an advisor or a fund or a small case or a PMS AIF, whatever it may be, that helps, where you are not stuck with your own idea, basically. So that's where we are on FIDI stats. Let's also look at the monthly numbers. So you can see that, yeah, since last week, FI selling has increased, and FI cumulative for the month has gone to minus 15,000, whereas DIs continue to rock plus 84,000 in the last 1 month from DIs. So so this trend which had gone flat is still dipping again now, and the DI trend continues to go forward. So nothing much has changed on the FII front. We will need this trend to go higher to really boost the market, but market is reasonably, I would say, sound. Yes, the excesses of 2023 and 24 in some sectors, some stocks will not come back easily. So we need to be in the sectors which are moving now, and we have to let go of your losses. The biggest learning that you can get from the market is, you you can't be emotional about your stocks. You have to treat it like a business. If something is bleeding, you have to cut that part out and move on. That's how you will be able to accumulate and compound in the markets. Let me know how you like this content. Thank you so much for watching. Thank you so much for subscribing to our channel. We don't appreciate our subscribers much, but I can tell you that the kind of feedback, the comments, if you read through the video comments that we get on YouTube, thank you so much. I mean, it is really heartwarming to read your comments. Thanks. Bye.